All right, everyone, welcome to our November market commentary. We're doing things a little bit different this month. First of all, we're recording this. We didn't do it live this month, but we thought we'd try this out. Additionally, we're going to be focusing mostly on the election and how to move forward from here with the results that we now have. So we're calling this our post-election market commentary. So
That's right.
my name is Austin Costello. I'm a certified financial planner with Capital Financial Planners, and I'm joined here by Neil Cain, also a certified financial planner, the owner here, president at Capital Financial Planners, and today we'll be giving you guys an outlook of what we see going on after the election that just happened. So, Neil, why don't you take us away?
Thank you, sir. Appreciate the intro. So obviously, fear around the election cycle is a very normal thing. We have a pretty undivided country, I'd say, and there's polarizing kind of figures on each side where we're getting that fear that kind of sells the agenda, and it just makes it feel like that the world is kind of hanging on this election. But really, if we start to think about the bigger picture, Austin, and you can advance the slide, the idea around the fact that we know exactly what will happen here, whether it's the market's going to drop because the election, or whether the economy is going to sink on the election results. Really, at the end of the day, we don't really know what will happen, and a lot of that comes from overconfidence. We think that a certain outcome is going to happen, but what we don't want, right? What we don't want is that fear part to take control of our decision making, specifically when it comes to the election, right? Because it gives a tendency to want to protect yourself. Now, we understand that there are emotions running high on the election, and that particularly for federal employees in certain agencies, that fear is very real. So we don't want to downplay that. But when it comes to investing your portfolio, such as your TSP, don't let that fear sink in there and make those decisions around your investment accounts. And Austin, I think you got a slide that shows us why we should be thinking a little bit more long term on this than being short sighted.
Yeah, definitely. And like Neil said, right, the whole agenda of the media around these elections on both sides is to drive fear, because that's how they drive us to get out and vote, right? But the negative side of that fear is it can cause us to make emotional decisions, which has proven time and time again to be the worst type of decision for our investment. So our job here today is not to give you, this, we wound up in a good situation or a bad situation or anything like that. Our job here today is to try to take the most unbiased approach possible and help figure out the best way to live in this and make the best of the scenario we're in. So I think the best way to start that is to look back historically and see what has each party meant for the stock market, right? And when we look back historically, growth has happened under Democratic presidents, Republican presidents. Doesn't really matter which party has been in power or had the presidency. We've seen growth across the board. As a matter of fact, if you were to only invest during Democratic or Republican presidencies, you would be sorely out of luck, right? The saying fully invested during either party has been the way to go, and we've seen growth regardless. So we've got a lot of questions recently because we're in the situation of we have some certainty around the presidency now, but the House and the Senate is still kind of up. And so we've had some questions on what has been best, has been the best mix there. So Neil, tell us a little bit about that.
Right. So, from my understanding, right, this is still up for grabs. But when we kind of look at the possible scenarios around the Senate, the House, and obviously now the Republican president, both scenarios here historically that are on the table have played out fairly well for the markets. Again, we're just going to try to talk mainly about the markets here. The markets, which have a underlying, or the underlying effect on that is going to be the economic activity going on. But sometimes markets can deviate from exactly what's going on economically. But bottom line is both both possible outcomes here have been pretty good scenarios for the market. So let's look at the first one. If we get a Republican Senate, but a Democratic House and a Republican president, on average, going back to 1933, the market's done over 13% a year. I would take that any day. That's the best option. A divided, let's call it, House and Senate with a Republican president. Number one option in terms of S&P 500 returns over the history. If we look at the possible other scenario, which is that Republicans do a full sweep, they take all of the Congress, Senate and House, get the majority, and then obviously have a Republican president. You've got a slightly worse return historically on the S&P 500, but not by a lot. Not by a lot. So again, we're not trying to play, favor. We're not trying to be favorable to one or another. We're just trying to show you the history that either of these outcomes right now are actually pretty decent scenarios when it comes to your investment portfolios. Okay, so that's another kind of fact that we want to put in terms of dissipating this doom and gloom that most people are feeling, depending on what agency and what federal department that they're working for. So trying to keep this a little positive, if you can see. Austin, what do you got in terms of where we're going in terms of the House?
Yeah, so what I pulled up here is just where we are right now. We took a screenshot of this right before the call, and so obviously the president's been decided, the Senate has essentially been decided with a Republican majority, and so all we're waiting on right now is the House. We're still waiting for results to come in, and this is what it looks like with the Republicans with a slight edge. But again, going back to this slide, right? The Republican sweep, or having that divided House and Senate, honestly, having a little bit of disagreement in Congress has been the best for us overall. So moving on from here, there's this narrative around this current election that this is different from any other time. And so we started out this commentary talking about the past, how neither Democrat nor Republican has really been better than the other in terms of market returns and economy. And people are saying, well, that's all great, but this time's different, right? We're in unprecedented times. We've never seen anything quite like this. And the reality is we're always in unprecedented times. When we look back throughout history, right, at how resilient the U.S. has been, I know that these titles are a little bit small, but each of these indicators here with a title is representing some sort of U.S. or global unprecedented event. Right, we've got Soviet Union invades Afghanistan back in the 70s. We've got the fall of the Berlin Wall. We've got the Cold War ending. We've got the 9/11 terrorist attacks. Right, we've got all of these different unprecedented times, and what this shows us is that the strength of the U.S. economy and the strength of the market. Sometimes we put too much of that weight on one single person, and honestly, what we should be paying attention to is the strength of companies and the innovation in the US. Now, again, I want to take this back and say what Neil said a couple times here, that throughout this presentation, we're focusing solely on the economic impact, the stock market impact, the things that it's our job to tell you about. We understand that there's other things that people are concerned about, and that is not what we're commenting on here today. So we're looking strictly at the market here and how resilient the economy has been throughout all of these times. Now, what we've done so far is we've looked backwards, right? So now that we have some clarity on what the president's going to look like, we have some clarity on what Congress is going to look like, or at least half of it. Neil, what does that tell us about what that could mean for us in this next few years?
Sure, sure. Yeah, we covered this on the last go around a little bit. We showed some side by side looks. So now that we got Trump in office, his objective is to lower corporate taxes, right? Lowering corporate tax rate from 21 to 20 isn't going to make a big difference there. But for retirees, the plan currently on the table is to eliminate taxes on Social Security benefits. I would say that's a big one. Additionally, for folks that are working, go ahead, Austin.
Well, I was just going to chime in there because I don't know about you, Neil, but a lot of the people I talk to, especially recently, have been really concerned about Social Security going away. And I just wanted to chime in there on that one because I think it's interesting that not only is the proposal not to take away Social Security, but it's actually to reduce taxes on Social Security. So a little bit of a silver lining there for some people that have been fearful of that happening.
Fair point. Fair point. Another big one for the Trump administration, right, is to make the Tax Cuts and Job Acts, essentially tax brackets of 2017 permanent. We'll be showing you that in some future slides, but essentially that keeps this low tax regime from an individual tax rate perspective low for the indefinite future. We've been talking about our concerns about tax rates going up. We still think that that's a future possibility, but just not under this administration. The other proposal, which I think is one of the biggest impacts to the bottom line on tax returns, would be to reinstate an unlimited deduction for state and local tax paid when it comes to property as well as state income taxes. Okay, so think about it. If you live on the East Coast, you're likely to be surpassing the $10,000 limit when it comes to the combination of your property and state income tax paid, right? So the current law caps your deductions at $10,000, whether you're married or you're single, which really hurts married folks. So now, if we reinstate the unlimited deduction, for example, if you have, both spouses are working and each of you are paying $10,000 in state income tax, right? You've got $20,000 there. And then you've got property taxes for $7,000. I'm just throwing out a number. Now you can deduct or itemize $27,000 as opposed to $10,000. That's a big deal. Now, keep in mind, though, there's been no talks of lowering the standard deduction. The standard deduction is pretty high, so it's still a very high hurdle rate. It's about $29,000 standard deduction. So you'd still have to have some other deductions beyond that to still deduct those. But bottom line, this could be helpful. The other kind of part on the proposal here that stands out is the tariffs. There's been talks about how that could be challenging economically. What I will say is the concern around that is more so long term. And if we start to look at the ramifications of this proposal from our point of view, is that near term, this helps pretty much each class, lower, middle, upper, okay, on those lower taxes. the unlimited deduction in terms of state and property tax. So that's a net benefit there. Also, short term, businesses get a nod in terms of the lower corporate tax rate. In terms of higher prices, though, we could see higher prices caused by these tariffs, which could limit some of the benefits of these tax reductions. So there could be a net kind of wash there. And this is the long term concern. If some of these proposals go through, the concern would be an increase to the deficit by over $5 trillion over the next 10 years, which essentially leads to a reignition of inflation. Okay. And that would be the concern for the longer term impacts. Now, of course, that would not be felt until most likely after this administration's done, because we know it's only going to be for 4 years. But Austin, kind of tell us exactly what you're seeing in terms of the adjustments, the economic forecast for inflation and growth under the new administration.
Sure. So we'll just put some visuals or some numbers to a few of those things that you just mentioned, Neil. And this is some research done by Schroeder Economic Group. That's just making projections, and this was actually just before the election. This was done on the Democratic, the current party versus a Republican proposals. And what this looked like, as you can see here, 2025, 26, 27, they are expecting GDP, so economic growth in the U.S., to be higher under the Republican proposals. Okay, a lot of that has to do with the tax reductions, right? When taxes are reduced, economic production can be higher because more of that money staying in people's hands, right? Now, what that means, though, where you see this difference is under inflation, right? When you look at the inflation projections for 25, 26, 27, you see a re-acceleration potentially of projected inflation under the Republican plan, where under the Democratic plan, we just kind of had that taper off because that's what has been being prepared for, I guess you could say. Now, what does that mean for us as consumers, right? If inflation doesn't continue this downward trajectory, if things get more expensive again, if we start to see a reacceleration of that, the impact of that is going to be felt by us through interest rates, right? Obviously through the price of things getting higher, but then when interest rates remain higher to combat that inflation, that's going to impact things like mortgage rates, right? If you were hoping to refinance your mortgage, if you got one of these 7.5% mortgages and you were hoping you were going to be able to refinance that back down to 3% in the next couple of years, you might be waiting a little while, right? If inflation stays higher, we're going to have to keep interest rates higher to combat that. Now, on the other side of that, higher rates aren't 100% bad, right? That means, hey, if you're in retirement and you've got money in bonds or you've got money in high yield savings, those are going to be paying you decent rates. Okay, so we're expecting maybe high yield savings accounts to not fall down to paying 0.5% interest or things like that, but being able to get some higher rates there on those things. So this is, again, all projections. None of this is guaranteed. We have to remember what we talked about at the beginning, which is we don't know what this is going to look like. But based on the current proposals, these are things that we're looking forward at and trying to prepare for. So with all of that, again, knowing some of this uncertainty and not knowing exactly what's going to happen, but knowing the direction that Trump and the Republican Party would like to move, Neil, what are some things that we can be doing right now to try to make the best of the situation, try to take advantage of the current environment?
Sure. So we know that if the Tax Cuts and Job Act gets extended past 2026, then we've got lower rates across the board in all income brackets. wider ranges of income. It is our expectation that in the future we will at some point revert back to those brackets that were prior to 2018. So this just gives us a larger window of time to really start to think about whether we want to keep our retirement plans, let's say, in traditional plans, or whether we want to start converting those to Roth while we still have kind of a historically low tax rate. We kind of hone in right here on a brief history of taxes. Why do we say that tax rates are low right now? Well, simply put, take a look at marginal tax rate for $100,000 earner, $200,000 joint, adjusted for inflation. We're really in that lowest threshold possible, going back to 1942. So this is kind of the time to start acting on moving around some funds to Roth if you haven't yet. We think that there's a large sweet spot to move assets around, which we say is up to the 24% bracket. That bracket is way larger than it's ever been, right? So if you take a look at that figure that Austin's circling for us, it is almost double the size of what it was. Now, the green brackets would be adjusted for inflation, but at the end of the day, it was only a $75,000 bracket, whereas right now it's a $180,000 bracket. So you've got to think that if we're running that deficit, where is the funding going to come from? And it's going to most likely be taxpayer dollars that come into that equation. So that's where we stand. So if anything, this kind of prolongs the resetting of the tax brackets. So you could consider that a good thing for right now, and consider that your opportunity to start really being strategic about your tax planning.
Yeah, it's when you compare these couple things that we just talked about, right? Tax rates staying low, but also adding money to the deficit. It's hard to see a world, and this is what Neil was just alluding to, that unless something fundamentally changes about the way our government runs or collects revenue, it's hard to believe there's a world where taxes are staying this low forever. But of course, we don't know the future. But what we do know is, looking at this, lowest rates since the 1940s, this can be a good opportunity. So that's the way we're approaching it, and that's the advice that we're going to be giving going forward. So I just want to wrap it up. Whenever we're talking about investing in a smart way, who better to listen to than Warren Buffett, right? And to tie in what Neil started this conversation talking about, the fear and the uncertainty and all of that encircles this election time. I just think this quote is so powerful that we don't have to be smarter than the rest. We don't have to predict what's going to happen. We just have to be more disciplined than the rest and stick to our plan. And that's how we make it to and through retirement successfully. So we're going to wrap it up there with our presentation today. If you are enjoying these presentations, if you want to be in the loop on everything that we're presenting, please subscribe to our channel and like this video. If you are getting value from this, that means people like you probably would also get value from this. And the way they're able to see that is by you interacting and subscribing here. Additionally, if this is a time for you that makes you feel very unsettled, I guess, financially, you're uncertain about your future, and we know that's a very real possibility for some of the federal employees that will be watching this. If you're feeling unsettled about your financial future, you want to get some clarity there. We offer something called a financial checkup. It's a free call. It's a free call with either me or Neil or one of our other advisors or financial coaches. And you can register for that here, retfed.com/register, or you can scan this QR code. This other QR code gets you to our YouTube channel. So if you're already here, don't worry about that one. But feel free to sign up for a free financial checkup here, and we can work through whatever is causing you concern right now. So, Neil, anything to add before we wrap it up for today?
Nope, that's it. I think we hit all the points.
Great. Well, thanks for watching, everybody, and we'll catch you next time. Bye.
All right.